Good morning. You're watching a live market outlook for Tuesday, 1st of November 2011, prepared by Windsor Brokers. The beginning of the month with a quite pessimistic tone as the initial optimism that came after the last week's European Union summit and the steps agreed in order to tackle the debt crisis is now fading, and the heavy risk aversion is back in play. Euro is suffering heavy losses from yesterday after the intervention of Bank of Japan pushed the dollar significantly higher, and then the euro continues to travel south, losing 138 support this morning, and currently on heavy sales from big Russian and Swiss names, pushing the pair towards 137 support. The further weakness of euro was also supported, actually was put an additional pressure on the European single currency after Greek Prime Minister Papandreou announced actually the shock announcement that he will put the bailout deal that was reached last week in order to try to contain the bloc's debt mountain to a referendum, and the voters to the people to decide whether to accept it or not to accept. Actually, this triggered the big anger within the Eurozone members, as they agreed already that second 130 billion euros bailout and 50% of write down on the Greece's enormous debt to make it sustainable. The Papandreou, however, who is head of the Socialist Party, already suffered several deficit defections, and as it pushes waves of austerity measures to the parliament, while protesters rally outside, said he needed wider political backing for the fiscal measures and structural reforms demanded by international lenders. So the comments that came out, we said that like the referendum is likely to be early next year, and the only Greece is second in almost 40 years. Actually, this is the latest opinion showed by majority of Greeks took a negative view of the bailout deal. So as we know, the heavy protests were in Greece, especially in Athens, and now the Papandreou is putting the ball on the people's actually part of the field to decide whether they want to proceed or not. Actually, this is one of the main reasons for further weakness of the euro, and as we can see, the initial strong optimism that pushed the euro to the fresh 9 months highs against the dollar is now completely out, as the recent gains from past weeks after the announcement of the deal on Eurozone summit were completely erased, and the euro is now traveling lower, likely to test the key short-term support at 136.55. The other instruments also affected, especially the commodities, as the gold is lower and approaching the strong support at 1700 zone, while the crude oil is lower, and the risk for a further extension down towards 90 initial and strong support. The dollar yen remains flat this morning after yesterday's intervention and the corrective pullback that erased quite good part of the rally. Sterling is also weaker this morning, testing 160, the psychological support, but the wider picture still remains intact, while the dollar Swiss is steady, going higher, and they're looking for test of next barrier, which is at 89 zone. Another news that shook the markets yesterday and today is actually the announcement of the MF Global, one of the leading world brokerage companies, bankruptcy. As yesterday they filed for Chapter 11 for the bankruptcy protection after heavy discussions and talks with several big world banks that gave their bid for buying the company failed, and yesterday the company, the MF Global, signed for the bankruptcy protection. However, the impact of this is even wider, as the latest reports from New York Times saying that quite big amounts of money have just disappeared, the investors' money, and now the investigation is underway, started from late yesterday, trying to sort out all these problems and rumors about missing money. So we'll be also following closely this event. From today's calendar, already released during the night, the Australia's central bank slashed the rates by 0.25% to 4.5 from the original 4.75, according to expectations. Also, currently is to be released the Swiss retail sales that are expected in a more positive way. Actually, they are already out. Just a second. Swiss. Wow. Pardon, I was looking to the wrong calendar. From UK, at 9:30 GMT is the manufacturing PMI. For forecast for today is 50 compared to the 51.1 the previous release. And then the preliminary GDP quarterly expectations for today are slight growth of by 0.4% compared to the previous quarter at 0.1%. We'll come to the UK after the calendar, as also some black clouds are coming over the UK's economy, so we'll give some more comments. Also from US today, ISM manufacturing PMI due at 1400 GMT. Expectations for today 52.1 versus the 51.6 the previous release. At the same time, monthly construction spending expected to decrease by 0.4% versus the expected to grow by 0.4% versus the previous month, raised by 1.4%, and the ISM manufacturing prices from US at the same time, slight decrease expected today, 55.1 versus 56 the previous release. Now about UK, the Britain's economy has probably picked up over the next summer, as today's forecast for GDP shows some more positive results. Though this will not change the wider picture of an economy teetering on the brink of recession, as crucial growth drivers such as manufacturing are still stalling. The Bank of England launched a fresh round of quantitative easing in early October, pumping another £75 billion of cash into the economy, as policymakers warned that euro crisis threatens to push Britain into recession. The Office for National Statistics will publish today the preliminary GDP results, as we mentioned already in our comments, and the expectation is growth of 0.4% for the period. However, most of this is seen as a mere rebound from a weak growth of 0.1% in the second quarter, when an extra holiday for Britain's royal wedding and supply chain disruptions caused the tsunami in Japan shaved off as much as 0.5 percentage points from quarterly growth. The manufacturing purchasing manager index for October might also shed more light in the state of the economy. as they tend to have the view that the recovery of the PMI in September was a sort of mirage. Economists actually see the PMI that is due at 9:28 GMT falling to a level of 50, reversing most of September surprise jump to 51.1 and indicating a stagnation in manufacturing. It's one of the few bright spots in the Britain's sluggish recovery so far. So we'll follow today's releases to have a more clear picture what how it's going to be based on the releases, and is it a real improvement or is just a temporary break ahead of further bad news to come. Now let's take a look on the charts and see the past 24 hours movements. As we can see on euro, heavy losses from 142.46, which was last Thursday's high, erased actually completely the latest leg higher from 138 after the release of the EU summit and release of the good news that gave extremely positive sentiment to the market, and euro was rallying sharply. Now yesterday's intervention of Bank of Japan that pushed the dollar higher further pressured the single currency, as well as today's news from Greece about the referendum. Now turning focus lower, we are at the 137.21, just ahead of 137 and 136.55, which is the higher platform of 18th and 20th of October, and actually this is the key support of the short-term move from 131.45 low to 142.46 high. As we can see, the pair is approaching 50% Fibonacci retracement of the entire move, below which comes the 136.55. Loss of this would signal a temporary top and the open way for further extension lower. The hourly and 4-hour studies are in the negative territory, also deeply oversold at this point. However, the market still doesn't take this into consideration, as the heavy pressure on euro and heavy sales are pushing the pair lower. However, we can expect some corrective action based on this technicals, but the near-term outlook remains very bearish. To confirm this also, we can see that on daily Chimoku studies, the pair returned back and broke below the cloud, confirming the bearish short-term outlook for euro dollar. The British pound is again under pressure after yesterday's rally from 159.64 low that was hit yesterday morning, where support was found after a brief break below the main trend line. Support extended the gains sharply higher to briefly break above the previous high at 161.51 and post marginally a new high at 161.64. However, the gains were short-lived, as a failure to hold the gains triggered a sharp reversal, losing the initial support at 160.70, and now we lost the psychological one at 160, approaching to initial strong support at 159.64. On the wider picture, I would say the bigger picture bullish outlook would still remain in play, as long as 159, 158.90 and the key support at 158.50 stay intact. So we might see some further reversal, but any reversal above 158.50 would keep 159 and 158.50 actually would keep the wider picture's positive tone still in play. Loss of 158.50 would turn bearish and signal further extension lower, where the 156.65 and the 156.30 will come in focus. On the daily outlook, the initial gains were capped by 200 days simple moving average that currently stands at 161.38, with loss of 90 days moving average now extending lower. We can see that studies are still directionless. The 200 days and 90 days moving average are moving sideways, so still keeping the positive to neutral wider picture. 20 days simple moving average on the daily chart is still pointing higher, and possible crossing above 55 days one would keep the current positive tone of 152.71 in play, and look for a further extension higher. A failure to clear the 200 days moving average would signal a temporary top, and the loss of the levels mentioned before, 159 and 158.50, would signal further weakness of the pair. The dollar yen remains sideways after yesterday's strong rally from 75.56, fresh record low posted in the early hours of yesterday. After intervention of Bank of Japan, pushed the pair significantly higher, gaining approximately 400 points and peaking at 79.52. Immediate pullback on the profit taking dropped down to 78 zone, which for now offers strong support. The current action is directionless, moving within a very narrow range. However, holding above 78 and 77.65, yesterday's high, which is also the previous, yesterday's low, also the previous high of the past over 2 months range, should contain the dips in order to keep this short-term positive tone of dollar yen. The hourly studies are still in the positive territory, as well as 4-hour ones. However, break above minimum 79 on the upside is to give a fresh direction of the pair and open a way for test of 79.52, yesterday's high, and then our next targets at 80, 80.23 and 80.50. On the downside, loss of 78 and 79.65 would risk a return back to the previous range, and the possible test of 77 zone that was original limit of the upside limit of the past few days price action. The dollar Swiss is in the firm bull tone after yesterday's gains were initially capped at 87.37, and the immediate pullback found support at 86.71, just above 86.50 support. Late yesterday's and overnights and early European session, strong gains cleared the initial resistance at 88.57 and 88.80. That was the previous resistance, and now testing the main bear trend line drawn of 93.13 high that currently stands at 88.92. Above here to confirm the near-term bullish structure and the open way for extension towards 89.50, and then the key short-term barrier at 90, and then 90.81, which is the high of 20th of October. Overextended, overbought actually, hourly, 4-hour and hourly RSI would signal some corrective action preceding a fresh rally. However, the outlook remains firmly bullish, so initial support would come at previous high at 88.57, and should be contained at levels above 80. Above 88 in order to maintain immediate bullish tone. Hourly 20 days moving average at 87.61, pointing higher, and is supporting the latest gains. Commodities came under pressure after the strong dollar continues. Actually, dollar continues to rally higher. As we can see, the gold gains were capped at 17.52 last Friday, and from then it continues to trend lower. As we can see, there is a formation of sort of head and shoulders pattern on the 4-hour chart, with the neckline approximately at 17.02, which are the lows of the recent of yesterday and last Thursday, and break below here to confirm the temporary top at 1752 and open way for test of next strong support at 1695 and possible extension lower. On the upside, holding above 1700, the previous strong resistance and now strong support might keep the near-term bullish action from 1603 in play for a possible extension higher with initial barrier at 1728 and then 1752 above which to focus the Fibonacci level 61.8% at 1770. As we can see, the daily 55 days moving average is still capping the upside, while the 90 days one still pointing higher and giving support at 1695 along with the previous highs at 1693 along with the previous highs at 1695. That is supporting from the downside for now. The crude oil is losing traction again as gains were initially capped at 94.58 and the next attempt higher stalled at 94.23, and the corrective wave from here is now losing this morning the support at 91.35 and turning focus down towards the strong support at 90, which is the low of 26th of October. On the daily chart, we can see that Fibonacci level 50% Fibonacci level at 95 zone along with the 200-day simple moving average is currently limiting the upside, while loss of $90 level would signal further reversal, opening levels at 89.66, which is previous high, and possible extension down to 84.20, which is the higher low of the entire move from 74.94 up to 94.58. So short-term outlook for crude oil is now negative, and the focus is on 90.00 as initial support, while above regain of 93.50, 94 is to improve the tone.